Hey guys, Happy New Year to you. I'm Joseph Graff, and in today's video, I'm going to be discussing 5 investments that I feel are currently undervalued. 2010 to 2020 was a great decade for investors. The Standard & Poor's 500 returned over 200%, and a lot of stocks are now currently sitting at all-time highs. There's a lot of optimism in the market, and that being said, I think it's a great time to remember a quote from Warren Buffett. He said, "Be fearful when others are greedy, and greedy when others are fearful." One of the ways I interpret this quote is just because a certain investment has done well historically does not mean it will continue to do so in the future. Don't jump in on a stock that you think has, because it's done really well, it's just going to keep going up and up and up. I think in times like these, when the stock market is at all-time highs, and people are very optimistic about things, I think now is a great time to look for value stocks. In my opinion, now is the time to invest in companies that might not be super flashy or have a ton of growth potential, but that you know are solid companies and are going to continue to produce profits year in and year out. And with that being said, we'll get into the video where I discuss 5 investments that I feel are undervalued. Before I start talking about investments that I feel are undervalued, I want to make sure that you all know that me talking about these stocks today is not me telling you to go out and buy them. I think some of these stocks could represent good value to certain investors. Before you make any sort of investment, always make sure to do your own research. With that being said, we'll talk about the first stock I feel is undervalued, which is going to be Kroger. So here I have some important data pulled up for Kroger stock. On the left, you can see the ticker symbol for Kroger, which is KR. Moving towards the right, you have the data that I obtained on January 1st of 2020 when the price was $29.06. The PE ratio was 14.84. The price to earnings growth rate is 2.21. And the dividend yield was 2.23%. Most of you all should be familiar with all these metrics with the exception of maybe PEG, which is the measure of a company's price to earnings ratio divided by its expected annual percentage growth rate. So the reason that I like Kroger stock so much is because it is trading at a significantly lower PE ratio compared to the Standard & Poor's 500. So the Standard & Poor's 500 is well above 20. I believe it's about 25 or 26 right now. And Kroger is currently trading at a little under 15. Now, this is one of my favorite indicators of a value stock is the PE ratio. Talking a little bit about Kroger specifics. So Kroger is a grocery chain, and I really like grocery stores because it's something that people are never going to stop going to, in my opinion. Amazon has tried to move into the grocery space, but they've found that trying to sell and deliver snack foods is not very profitable, and I don't see how they could possibly profitably deliver meat and produce here in the near future. Which is why I think Kroger has a pretty safe business model. I think, even if there was a recession, they would continue to make quite a bit of money. They'd have some pretty good profits. People aren't going to stop going to the grocery stores, and that's why I like Kroger. With that, I'll move on to the next stock that I'm going to talk about today, which is Goldman Sachs. So here you have some important data for Goldman Sachs. Its ticker symbol is GS. Its current price is about $230. Its PE ratio is about 10.27. Its price to earnings growth is about 1.29, and its dividend yield is at 2.17%. So I'm not sure why, but the financial sector has been really beaten down lately. A lot of financial stocks, bank stocks have been trading at very low PE ratios. I do not totally understand why this is, but I think Goldman Sachs represents a fantastic investment right now. based solely on its PE ratio. Goldman Sachs is a very big bank. I think the reason why it is so low in price right now is I think people are still afraid of big banks after the recession we had in 2007 or 2008, which is where a couple of the larger banks in America actually failed and the government had to come in and bail them out to prevent the economy from totally collapsing. So I think people are still kind of afraid of big banks. And going back to what I said earlier, my quote from Warren Buffett, he said, "Be greedy when others are fearful and be fearful when others are greedy." I think now is a great time to be greedy when people are being fearful of these big banks. Just these metrics shown on screen make it almost too hard to pass up as an investment, in my opinion. The PEG ratio is very low, which means that this company is projected to grow quite a bit in the coming years, which is not very common for value stocks. This, in combination with its very low PE ratio, is one of the reasons why I think it represents a good value at this point. With that being said, I'll move on to the next stock that I'm going to talk about today, which is Exxon Mobil. So here we have the data pulled up for Exxon Mobil. It's currently trading at about $69.48. Its PE ratio is 20.24. Its price to earnings growth is 2.05, and it's yielding almost 5%. So one of the main reasons that I like Exxon Mobil, and I actually own a share of this in my Robinhood, and I also own a couple shares of it in a dividend reinvestment plan, is its dividend. This 5% dividend is much higher than the rest of the market, and I like it solely for this reason. They did raise their dividend once this year, which is typically a good sign that a company is profitable and growing. It's trading at 20.24 PE ratio, which is lower than the Standard & Poor's 500 PE ratio. It's not nearly at the levels that Kroger or Goldman Sachs are at, but it still represents a value in my opinion. I like Exxon Mobil because it's a huge company. They specialize in oil. The world would not function without oil. We still have gas-powered cars. I think a lot of people are afraid of Exxon Mobil, maybe don't expect it to do well in the coming years because it is an oil company, and I think there's the general perception that we are shifting more to renewable energy. But with that, I think there are still many good years of oil use ahead for America. I just don't think the technology is there yet to where we will be using a lot of solar energy or hydro energy or wind energy in the next few years. So I think Exxon Mobil is a good stock. I don't think it's necessarily as good of a value as Goldman Sachs is, but I think it's definitely worth some research. So that brings me to the next investment that I'm going to talk about today, which is not a stock, but actually an ETF. Its ticker symbol is VT, and it's a Vanguard Total World Fund. So here we have the Vanguard Total World Fund, ticker symbol VT. Its current price is $80.66. It's trading at a 16.61 PE ratio. There was not any data available for its price to earnings growth, probably because it is a collection of many different stocks, and its dividend yield is currently at 1.78%. So I personally think that a lot of people don't realize or don't think about the fact that you don't have to invest in American companies. This ETF offers some exposure to foreign stock markets, and one of the reasons its PE ratio is so low is because a lot of these companies in foreign countries have significantly lower PE ratios than some of the companies here in America. Now, that being said, this ETF is composed of about 45% of American-based companies and then 55% of foreign companies. So while it does offer some exposure to foreign markets, you also have almost half exposure to the American market. So like I said, this is just a good way to be invested in markets outside of the Standard & Poor 500, outside of American companies, and a lot of these companies are trading at lower PE multiples than the Standard & Poor 500, which is why I like VT as an investment. And with that, we'll talk about the last stock that I am going to talk about today, which is United Rentals. So here we have data on United Rentals, which is a company that mainly rents out and sells used construction equipment. As you can see, the ticker symbol is URI. The price was at $168.36. The PE ratio at 11.64. The price to earnings growth at 1.62, and it does not pay a dividend. So the reason that I like United Rentals is because of this low PE ratio, indicating to me that it is potentially a good value. This PE ratio is the second lowest of the investments that we've talked today, only higher than Goldman Sachs. And one of the main reasons that I really like this company is just because of their business model. I think being in the rental industry can be very lucrative. If you think about it, a lot of these things that they rent out require a large upfront cost to buy the equipment, and then after that, renting it out is mostly profit. You need people to manage your rentals, make sure things get returned on time. But for the most part, I think it can be a very profitable industry, especially when the economy is doing well like it is right now. Well, with that, I think I'm going to wrap up today's video. Thank you all for watching. I hope you all got some good investment ideas. As always, make sure to do your own homework, do your own research before you decide to invest in a company or make any sort of investment. And if you like today's video, please hit the like button below. Please subscribe to my channel. And with that, thank you all. I'm out.